Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Beijing Geekplus Technology Co. Limited annual report. Beijing Geekplus Technology Co. Limited is a leading provider of artificial intelligence and robotics technology solutions for logistics. The company offers a range of innovative products and services that cater to various industries. At the core of its offerings are autonomous mobile robots, AMR, solutions and robotics as a service, RaaS, which enable businesses to streamline their operations and improve efficiency. Specifically, Geekplus provides three key systems: picking system, moving system, and sorting system. The picking system is a comprehensive solution that includes Geek robots, backstage control system, standard picking station, and charging station. This system enables goods-to-person picking by allowing robots to carry shelves, thereby increasing productivity and reducing labor costs. The moving system, on the other hand, realizes automatic material handling through the use of robots that can carry shelves or pallets. This solution is designed to optimize warehouse operations and improve supply chain efficiency. Lastly, the sorting system enables fast automatic sorting through cooperation with industrial code reading equipment. This system sends parcels to corresponding shipment ports, ensuring timely delivery and reducing errors. Geekplus products have far-reaching applications across various sectors, including e-commerce, retail, 3PL, medical, clothing, food, daily consumables, manufacturing, and automobile industries. With a global presence in multiple countries, the company is well-positioned to cater to the growing demand for logistics solutions worldwide. Beijing Geekplus Technology Co. Limited maintains a market capitalization of $24 billion, broadly in line with the industry peer group. Beijing Geekplus Technology Co. Limited trades at a lower price-to-book ratio of -2.88 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 295% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the sales of robotic solutions have seen a significant increase of between 31.6–32.4%. This is a notable contributor to revenue growth, indicating that the company's focus on robotics has paid off. Another factor driving revenue growth is the strong global market demand for the company's products and services. As the world becomes increasingly reliant on automation and technology, companies like this one are well-positioned to capitalize on this trend. Additionally, the upgrading of standardization capabilities has also contributed to revenue growth, allowing the company to streamline its operations and improve efficiency. Furthermore, steady growth in customer repurchase rates is another significant driver of revenue growth. This suggests that customers are satisfied with the company's products and services, leading to repeat business and increased loyalty. The large-scale sales of robotics solutions have also played a role in driving revenue growth, indicating that the company has been successful in securing major contracts. In contrast, there is limited information on the primary drivers of revenue decline. While some pages mention that none are mentioned, it suggests that the company's focus on growth and expansion may be outweighing any potential challenges or setbacks. Net income and profit margins. A shift in favor of growth in 2025, the the company's net income experienced a significant turnaround from a loss in 2024. According to the financial reports, net income increased to RMB 43.8 million in 2025, marking a substantial improvement over the previous year. However, a more detailed analysis reveals that net income actually rose from RMB 837.2 million in 2024 to RMB 1,125 million in 2025. This increase in net income is accompanied by an uptick in profit margins. The company's gross margin expanded from 34.8% in 2024 to 35.5% in 2025. While the exact reasons for this change are not explicitly stated, it is clear that multiple factors have contributed to the improvement. The growth in net income and profit margins suggests a positive shift in the company's financial performance. As the company continues to navigate its business operations, it will be essential to identify and build upon these strengths to drive further success. The company's financial performance has shown a notable improvement in its operating cash flow. In contrast to the previous year, where it experienced a net cash outflow of RMB 108.1 million, the current year has seen a significant turnaround with a net cash inflow of RMB 85.7 million from operating activities. This positive shift indicates that the company is now generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. Management is optimistic about the company's future prospects, citing its recent achievement of profitability as a result of business expansion and economies of scale. This growth trajectory is expected to continue, driven by the company's ability to leverage its increased size and efficiency. In terms of strategy, management has emphasized the importance of prudent financial management. Specifically, they will be closely monitoring funding costs and loan maturity profiles in order to identify opportunities for refinancing at favorable rates. This approach reflects a cautious yet proactive approach to managing the company's finances. Overall, management's outlook is one of steady growth and responsible stewardship, with no plans for significant investments or capital expenditures beyond what has already been disclosed. The company's financial strategy has been focused on retaining earnings rather than distributing them to shareholders. According to the provided information, there is no record of dividend payments made by the company. This suggests that the management has chosen to reinvest profits into the business, potentially for growth and expansion purposes. Furthermore, a review of the text reveals that there are no mentions or indications of share buybacks. This implies that the company has not utilized this method to reduce its outstanding shares and potentially boost earnings per share. Concerns have been raised regarding the buildup of inventory in various sectors. One notable issue is the significant increase in finished goods inventory, which rose by a substantial 25.7% from 2024 to 2025. This surge suggests that companies may be overstocking or struggling to manage their production levels effectively. Furthermore, while raw materials inventory also saw an increase of 15.3%, it was not as pronounced as the rise in finished goods inventory. This disparity could indicate that supply chain disruptions or inefficiencies are more prevalent at the production state rather than the procurement level. That concludes the financial summary for Beijing Geekplus Technology Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.